This is Conversations, a weekly financial podcast featuring interviews with leading investment strategists, noted technical analysts, and other key thought leaders. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Larry Connors. Larry Connors has over 30 years in the financial market industry. His opinions have been featured at the Wall Street Journal, Bloomberg, Dow Jones, and many others. For over 15 years, Larry Connors, and now Connors Research, has provided the highest quality data-driven research on trading for individual traders, hedge funds, proprietary trading firms, and bank trading desks around the world. Welcome to the program, Larry.
Thank you, Lance. Thank you for having me.
Well, let's start at the beginning. Tell me how you came to work in the financial markets.
It actually started when I was really young. My grandfather got me going as a birthday gift when I was 8 years old. He bought me stocks, two companies, one of them being Exxon. And I remember as just watching the stock prices each day and checking in on the newspaper. And that interest continued to grow through high school. Then when I went to college, I had my own, while I was in college, I had a few jobs and also had my own business and took the profits from the business and basically started investing or at least speculating in some of the lower price stocks and found my way just really having interest in the markets itself. I was fortunate enough to get hired by Merrill Lynch shortly after I finished school, and that was back in early 1982. And by 1994, I was pretty much ready to go off and do my own thing. And what we did was we moved ahead. Ultimately ended up building the Trading Markets website and have continued to provide research now for a couple of decades.
That's fantastic. I didn't know that when I asked you that question, but I love those generational stories. We've had lots of people on that work with their father, father-son, and so your grandfather got you hooked. I love that. So there's that family tie. Do you still have a special place in your heart for Exxon? Do you get nostalgic when you see the ticker come up?
Yeah, it's interesting. I do it. It does resonate, and we do a lot of our focus. We've on our asset management side, we do a lot of focus. It's especially on S&P 500 stocks. So Exxon comes into the portfolios. So we see that name a lot. So yes, it does have a special place in my heart.
So would you consider your approach to the market to be more technical, to be more quantitative, or is it hard to distinguish these days the difference between the two?
Yeah, I mean, on a pure technical basis, that's my roots. That's the baseline. What we've done over the years, which is real important, is taking the technical analysis and then quantifying the behavior. And for us, it was a natural progression. It's one thing to be able to see certain type of behavior and see it over and over again. It's another thing, though, to be able to take the next step. And the next step is really being able to go in and do proper testing and be able to see, okay, is this behavior real? What is going on? And then what are the best strategies available to take advantage of it on a risk-adjusted basis?
Now, I've seen your work pop up a lot. About 5 years ago, I think I saw your 7/7 strategy in Stocks and Commodities magazine. I've seen a lot of talk about Connors RSI, and even in our own MTA publications, I've seen some of your work. And everything, from what I've seen anyway, seems to be mean reversion strategies. First of all, is that accurate? Tell me how you approach the market.
We began with the approach many years ago on a mean reversion basis, and it was really much taking a specialist / market maker's mentality, taking the other side of the trade, and what we're ultimately able to see, and we continue to see today, is that's where the edges are on a short-term basis. So it's interesting because we see behavior that's out there. We have behavior that we were able to see many years ago, show test results, and then as we go on a walk-forward basis as the years pass, you continue to see that behavior continue to hold up. On a short-term basis, certainly mean reversion continues to have edges in place. some of the traditional ways of measuring mean reversion have been obsoleted. I believe some of it was tied into some of the high-frequency trading that goes on out there, some of the hedge funds that go out there. And what we've essentially done is we've advanced our mean reversion trading and research through the development of Connor's RSI. Connor's RSI is the only oscillator and indicator out there that we know of that basically shows historical results. You get to see the historical distribution of returns based upon the levels. So it's taking Wilder's RSI and taking the next step further with it, and we created Connor's RSI with that. So that covers the mean reversion part of that. On a longer term basis, where we see a combination of mean reversion, and we also see trend following. We've been able to quantify specific trend following behavior in the equity markets, and I think for us that was a major breakthrough because we had spent so many years on mean reversion. For us to be able to go in and take S&P stocks and show that, look, they do have a trending characteristic about them, and be able to create portfolios around them. And in fact, we use those trend following strategies that's included as part of our asset management firm. To be able to see that is great because if you have a balance of mean reversion combined with trend following, it allows you to potentially participate in all markets.
Now, I've seen you do stocks and ETFs. Do you do any work outside of that asset class? Do you do anything with futures, anything like that?
Well, we do a lot of work in the S&P on the S&P, so the S&P can obviously be used over in the futures. Our primary focus is on stocks, especially S&P 500 stocks, and also on ETFs. What we've done is we've since advanced it into the options markets. We've begun to quantify behavior within the options market, so we're able to look at different types of strategies. We have historical data from the CBOE, goes back as far as 2005, and what we're able to do is see, okay, when a setup has occurred, how have these options performed? So we've been able to expand the research into the option markets. And now with the weekly options, with the weekly options just continuing to grow and grow, it really makes it nice to be able to go into positions and be able to limit the risk, a fixed dollar risk. So instead of having to go out, for example, and buy SPY at 181, 182, 183, 184, one can go in, take a weekly option, predetermine what the risk is on a dollar amount. If they're right, they'll be able to, if prices move up at the appropriate amount, they'll be able to potentially profit. If they're wrong, they have a fixed dollar amount risk, and that's really nice to be able to do. With stops don't provide any type of any type of protection overnight or over the weekend. The thing with options is you can predetermine what that dollar risk is, and then you can expand that. And to go just a little bit further and to give other people credit with this, if you take a look at some of Dr. Van Tharp's work on R, which is R is defined as risk, we've seen it here with our customers. Many of our customers have become even more successful by embracing Dr. Tharp's work and basically going in with fixed risk with positions, and it really works out well. It works out real well, especially with the shorter term mean reversion strategies.
Well, can I put you on the spot here? Can I just have you flesh out because you're not a fan of using stop losses, but you're talking about fixed dollar risk. What's the difference between those two?
Okay, well, stop losses do play a role. They play a psychological role. You can see though they tend to hurt test results. But with that being said, if people are comfortable using stops, that's an important part. But when you get over into there were, for example, buy signals at the end of last week. So let's assume that there was a buy signal on Friday's close. And so on Friday's close, there was market sold off significantly on Thursday. It sold off again on Friday. There was a lot of fear in the marketplace. The SPYs went out at 181 and change. It's essentially if someone went long SPY, when someone's trading ETFs, there's basically open-ended risk there all the way. First, it ties up a lot of capital, and then there's open-ended risk all the way to the bottom. If one went in there and bought a weekly calls, okay, so basically it's defining a weekly call, and what they're doing is they're taking a fixed dollar amount. Let's say that fixed dollar amount is $1,000, and let's say the call is selling for $2. If SPY continued to drop, there are a lot of concerns about, possibly Russia going into Ukraine and some of the other things that were out there. If that did occur over the weekend, and SPY hypothetically opened up at 165 or even lower, that's a pretty good hit. But if someone basically has a fixed dollar amount, let's say went back and just risked $1,000 on that trade, they don't care how low SPY goes. It's just they lost 1 R. They lost one piece of that. And when people begin to start grasping that, you see greater control of the trading, and you see greater mastery of the trading, and overall, a number of people, and we've seen this also with institutions, they just have greater success longer term by having that fixed dollar amount risk embedded into the strategy.
Do you have a favorite strategy of all the ones you put out? Do you have one that you gravitate towards?
Yes, on a short-term basis, we have a strategy that's tied into volatility. We call volatility spikes. It's the highest performing strategy of anything we've ever published. It identifies short-term pullbacks in the markets and essentially identifies when the institutions are pausing in the buying before they're going ahead and buying again. That is somewhat of a bread and butter strategy, and we've seen a number of customers have significant success with that strategy. Connor's RSI is also strong. It's not so much a strategy, but Connor's RSI gives a good idea of where market conditions are. It really gives you an idea of just how overbought and oversold, and there's a lot of things that can be done with Connor's RSI. Then when we get into the longer term type of strategies where we're holding positions longer, certainly our trend following strategies on the S&P stocks are one piece there. People in us have seen good success with those S&P type of strategies on the trend following side. So there are a handful. Again, everything is based upon certain type of behavior, and everything is based upon having it quantified for numerous years, and in some cases it's numerous decades.
It seems to me that Connor's research is coming out with some very original work instead of just repackaging some of the same old things. Where's the idea generation coming from for this new work?
Our approach has pretty much been the same for a number of years. Usually it's made in an observation in the marketplace, so we'll observe some type of behavior in the marketplace, and then we'll go in and test that behavior. A second way to be able to do it is I like to focus on academic studies. I think many of the academic studies out there they're gems. There's some real gems that are made available, and sometimes they're made available not so much in the Journal of Finance, but you can find them in some obscure places. But what happens is there's certain type of behavior that gets quantified, a certain type of behavior that's there, and then what we're able to do is go in. Usually we're going to be overlaying some of our own knowledge and some of our own indicators to them. And what happens is when we combine the two, then ultimately you see some really nice things come out, and this is where some of the original research comes from. So again, it's either an observation made in the marketplace and we'll test it. It doesn't always, just because we observed it, it doesn't always work out. It's being tested. And also, same thing with the academic studies. Many times we can't replicate what the academic studies have at least shown. But there have been other things. There was a well-known study that was published, for example, back in 2004 that showed that the majority of gains in momentum stocks occurred around the times that stocks made 52-week highs. And what we were able to do is we were basically able to see that. We were able to see that there was a window of a buying opportunity, usually within a 4-week period of time, that one was able to buy on a pullback after it made a 52-week high and get back into these stocks. It really gave the opportunity to provide some great opportunities there. But again, that started with reading the academic study and then putting our pieces together.
Right, yeah, that's been the criticism with the academic studies is people can't get it to translate to the real world, and so you're able to fill in those gaps, it sounds like.
Not always, but sometimes. And we sometimes can. They turn out to be. They really do turn out to be gems. So a lot of credit does go to the professors who originally created that.
Okay. Now you mentioned this recording is being done today on March 17th, and you mentioned the strong selling that we had last week. What's your assessment of where we are at in the market today?
Yeah, April 17th, right?
April. What did I say?
Thought maybe we missed a month.
No, it's April 17th. Yes.
Last week's selling, it was more extreme. It certainly was media-induced. I read a daily piece, and I basically said that I wrote back then and said that this is a normal pullback. I think I wrote this on Monday. So this is just a normal pullback. The media seems to be inducing a lot of the hysteria out there. Certainly volatility spiked up higher, but as we saw, it was a normal pullback. Monday rallied, Tuesday rallied even further, Wednesday rallied even further. So it's back to normal. As long as the markets stay above the 200-day moving average, and at least in our opinion, we define that as being an upward trending market, meaning a bull market, and the strategies basically pertain to that. When you take a look at volatility, yes, it's moving up a little bit, absolutely moving up a little bit. But, if you look at the long-term reading on the VIX, now going back 20 years, the average reading has been approximately 20. It's a drop onto 20. So when we're trading VIX at 14 or 15, yes, that's higher than 12 or 13, where many people have gotten used to it. But over a 2-decade period, it's still a low volatility environment. And, essentially you can structure your strategies around that. Volatility will ultimately tell us if we're moving into a bear market. But right now, with volatility being in the low to mid-teens, it's business as usual.
Okay. Is there anything you would like to add before we go today?
Well, first, I want to thank you. I also want to thank everyone from the MTA. The MTA does a great job, and there's a lot of great information that comes out of the MTA. What I'd like to do is share with everybody. What we've done is we've updated the historical test results for Connors RSI. Connors RSI is now on a number of platforms. It's on Bloomberg. It's on a number of brokerage firm platforms. So it's free for everyone out there. The guidebook was originally published back in 2012. It showed the historical results at the different Connors RSI levels. What we've done is we've updated the results here through the first quarter of 2014, and it's available to everybody. It's available free to everybody in the MTA. So I believe, Lance, you're going to make that link available for everybody, and they'll be able to download it.
Yes, we will make that link available.
Okay, that'd be great. And if anybody has any questions about anyone has any questions about it, they can feel free to email me. My email address is lconnors@cg3.com, and just put MTA in the subject line so I'll know it's a fellow MTA member.
Excellent. Thank you for your time today, Larry.
Great. Thank you very much, Lance, and thank you, everyone.
Today's guest has been Larry Connors, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.